Hola.
Hola, te dejo que tú le presentes porque yo estoy en el Trayana Foods por la Cotopaxi, con ruido alrededor.
Ya, ok.
A ver, di algo.
¿Aló? Estoy con lapsus brutus. Wenyi es inglés total, ¿verdad?
¿Cómo? Inglés.
Wenyi, inglés.
Perdón. Ya me contestó el de Techstars de eventos.
Ah, eso vi ahorita.
A las 12 tuyas el miércoles está bien. Después de... ¿Qué es este programa, Fernando? Ah, este es mi puteada.
Es tu sesión de cierre. Sí, si es que ves que está
Sí,
libre en mi
hacemos algo.
calendario, sí, porfa.
Yeah.
Sí, yo creo que sí lo hacemos una hora.
No puedo. No, espérate.
Voy a dejar entrar a Wenyi.
Espérate.
Hi, Wenyi.
Hey.
How are you?
Good. Nice to see you, Carmen. Nice to see you, Fernando.
Nice to see you
Hey,
too.
Wenyi, how's it going?
Good.
How are things going?
I really liked your investor report.
Ah, thanks. You mean the 9 lessons?
The 9 lessons.
Yeah.
Yes.
Yeah, it's been a while. Lots of things that have happened.
We'll send you an update on our end.
Awesome. Yeah.
It's been a crazy
What did
year.
I read? What did I read from you lately?
Well, we're coming to the end of el programa. I remember talking to you before it even started, but
Yeah.
it's come by real fast. This is the second to last week before they get to show off, hopefully in the demo day. And this week we're focusing on fundraising, but on the side of the investor. We've had Angel Ventures. Tomorrow we'll be having Garao Ventures also, and it's a real pleasure to have you as always. So I'm gonna simply make a quick intro, 1 minute, 30-second intro, introduce you, and then you can take it away. And as we discussed yesterday, you can use up 30-40 minutes with your presentation, and then open it up to questions. There are days where the startups are more talkative, and others where I think they're starting a mini burnout. So if I jump in with some questions to guide the conversation, I'll do so, just to untangle some of the topics. And if not, I'll just let it flow with them.
Okay.
And
Sounds
do
good.
the same. Yeah.
Yeah, I noticed that the startups are still in pretty different phases when I was reading through the prep materials. So
Yeah, and that material is actually a little bit outdated. We're putting together the new book, because that information was when they applied to the program. So now we're finding out new things about them. But you're right. Some of them are in different stages, and yeah, I'm gonna start letting them in, and we can continue talking with them inside. Hola a todos.
Buen día.
Hola,
buenos días.
Hola, hola. Tenemos a Martín, Francisco, Ricardo.
Hola.
Juan Daniel creo que se quedó en el limbo, está ahí joining, pero no. Vamos a esperar un minutito más y arrancamos.
Traer una de esas galoneras acá.
Ahí te puse en mute, Rafael.
Buenos días con todos. Andrés saluda.
Hola Andrés, ¿cómo estás?
Todo bien, gracias.
Hola.
Well, today we have another English session with a fantastic guest, Wenyi. She's been at Buen Trip events in the past. We're close. Polymath and Buen Trip Ventures and Buen Trip Hub, we're real close. And I really wanna focus today on. Sorry, I really want to thank Wenyi for joining today. Today's session is a little bit of a hybrid, because even though we're focusing this week on fundraising on the side of the investor, I think Wenyi has a very particular perspective on fundraising, because she comes from Polymath Ventures. Polymath Ventures is a venture builder. So it's a different perspective on fundraising and on raising capital for a very particular situation. So when he's gonna give us a little bit more of context around that, but last year she gave a phenomenal talk on the learnings she's had while fundraising for, I don't remember the number, Wendy, but it was several rounds and several projects. So I don't want to continue to ramble, but thank you, Wendy, for being here. And we're going to have an initial part of the conversation with a presentation by Wendy, and then we're going to continue on with Q&A. And it's up to you guys to make the smart questions. Thank you, Wendy. Take it away.
Thanks, Carmen, and thanks, Fernando, for the invites as well. So very happy to be here. I think this next hour and a half is for you guys. Fundraising is hard, right? And it takes a lot of energy, it takes a lot of kind of experience to understand what works and what doesn't work, and it's a necessary path. And so I'm hoping, I have a short presentation kind of consolidating the lessons learned, and then I'm hoping just to be able to have a good chat and be helpful to those of you who are kind of embarking on the fundraising pathway or have already started doing so. As background, let me start sharing the presentation. Give me 1 second. Carmen, I think you need to enable me. Okay, so as background on myself, I'm originally Chinese, educated in the US, and have been kind of doing different types of businesses around the world for a while now. I worked in the Middle East and Africa before being an entrepreneur in Silicon Valley and selling a company to eBay. And then I came to Latin America at this point 9 years ago and have been building Polymath in the region. We have offices in Colombia and in Mexico, and our ventures operate between Mexico, Colombia, and Peru. So pretty, been doing business in the region for a while, been seeing the fundraising landscape evolve over time. So congratulations to all of you that you're raising right now, rather than like 8 years ago when I started raising capital for the region. So it's much, I think it's a much better landscape today. And, but I think it's still a very complex journey. I have, my experience has been raising in the region from international investors, both in the US and in Asia. And so there's some, I would say there's differences and there's similarities ultimately. So happy to also answer questions on that front later. Okay, Carmen, I'm able to share now, yes? Okay, perfect.
Yeah.
Please do. Okay. So, 1 second. You guys are able to see my screen, yes?
Yep.
Okay, perfect. So as mentioned, Polymath is a venture studio. We build companies from scratch internally. So I think we have this view both from the actual entrepreneur's perspective, because we're co-founders of the ventures, but also from an investor's perspective, and when do we follow on and continue investing in the companies that we're still that are from our portfolio, right? And in addition to that, Polymath itself has to raise funding from investors to Polymath, which is actually a holding company. It's not a fund. So there's like also a totally different set of investors that we interact with for our own fundraising. So we do have a little bit of a kind of wider, I would say, aperture in terms of the fundraising landscape, both from like a startup perspective as well as from, let's say, a VC trying to raise from an LP, although venture studios are much more novel of a concept. And so there's an entire component of convincing investors why this is the right model for investing in early stage. So in terms of Polymath itself, we've built 11 companies over the last 9 years. 6 of those are still operating and growing. Some of the other ones have failed and some of them have been sold. We've raised in total $41 million of equity and a bunch more debt in the group. And we have about over 300 people kind of working across Polymath as well as the portfolio companies. We have about 45 people at the Polymath level. And so as a little bit of background, fundraising is an ultra marathon. I think for us, it's been an ultra marathon. So over the last probably 8 years that we've been doing fundraising, we've completed over 43 rounds of financing. That means we probably generated 6,000 to 7,000 investor leads. We've had over 2,000 pitch meetings and raised over $40 million of equity. And again, this doesn't even count like debt for some of our companies that are in fintech and so forth. So if you were to like synthesize the impact of these numbers, the word to take away is grit, right? So I've not personally taken all 2,000 meetings, but I probably pitched like 1,000 times with Polymath and kind of supporting the ventures and pitching. And some of those rounds were, you know, small financing rounds where it was really just friends and family. And of course, many of them over the last few years have been multi-million-dollar institutional rounds from international investors, right? So what I want to say with these numbers is that there's actually very little glory in fundraising, no matter how the media portrays it. So the tech media tends to only, you know, give press releases when rounds have been financed, and really the reality is kind of just a bare-fisted fight in the mud, right? There's and what I wanted to do today is kind of share some of the key lessons that I've learned through all the blood, sweat, and tears of fighting across different scenarios over the last years. So hopefully this will be useful to you. So lesson number one is fundraising is hard, right? So don't be fooled by all this media. It often feels like everybody's raising except you. So it's kind of like high school, like given the incentives of disclosure, it seems like everybody's having sex besides you. So if you speak to almost every single entrepreneur and they're being honest with you, they'll probably say that it's damn hard and it's probably the hardest part of their job. So I think the first lesson is like recognizing this, right? And taking it very, very seriously. The second, and the other aspect of this is, you know, people who have been tracking their funnels in a more rigorous way usually come up with something like the 6% rule. So that out of 100 investors that you contact, only 6% of them will invest. So I think this means that you're going to get no's all the time, right? The much more likely answer you're going to get from investors is no, for whatever reason, and sometimes they don't even give you a reason. So if you need 6 tickets of $100,000, right, to reach a $600,000 round, you need to speak to 100 investors that can actually write $100,000 checks. So there's a lot of qualification needed, even in terms of the number of investors you speak to. And fundraising is just hard work. It requires developing pretty deep, thick skin and being able to deal with no's all the time. I mean, there's just no other way around it. The second lesson is fundraising is a fundamental skill of a startup CEO, right? So you can decide to bootstrap your startup and never raise or raise very little equity capital. I've had friends who are, you know, who actually didn't raise significant funding in the early days, but to grow their businesses, they're now raising capital. So chances are you will need some type of financing to go through different parts of the business journey, whether it's to start, to grow, and sometimes to deal with hard times. So fundraising is just very likely an important activity that is needed for your startup to be successful. And I think it took myself a really long time to admit this, but I'm not a natural salesperson. I'm a problem solver, I'm an innovator, I'm a good operator, but the sooner you realize as an entrepreneur, and especially as a startup CEO, founding CEO, is that knowing how to sell, to fundraise is a fundamental skill, right? And the more likely that you will focus, so like the sooner you realize this, the more you're going to actually focus your effort to learn it and spend the right energy on it. And so this seems pretty straightforward, but I think a lot of people don't realize this, right? People think, oh, like my job is to run the company or to whatever, build the team, and I do fundraising when I need it. No, it's kind of like a fundamental part of your job as a founding CEO. So lesson number 3 is to think of your investors as your customers, right? So most of us probably talk a lot about user-centered or customer-centered in building our businesses. I would encourage you to think about your investors in the same way. So there are very different types of investors, and they want to get different things out of investing. So some only care about returns, some want to engage. Yeah, go ahead.
No, it's someone that's not muted. Go on.
Okay, all right, no worries. So some of these investors only care about returns. Some want to be engaged with like an exciting new project. Some want to give back and mentor younger people. Some want to feel important and heard, right? They want to feel that the experiences they've accumulated over time is useful to creating something new. And some people just want to have impact in as many people's lives as possible. So you really need to understand these different segmentations of investors and what is the most compelling part of what you're selling, and figure out what the investors want to buy, right? So we talk about product market fit for startups. I think there's a component of like startup investor fit or founder investor fit, right? So just to give you an example, Polymath, our ventures, because we focus on middle class, Latin America, there's a pretty significant social impact component to what we're doing, right? The demographic we're serving. But the problem is that Latin America is not particularly well, it's not a place where a lot of global impact investors pay attention to, because it's a little bit too rich for people that focus on Africa and India and so forth. And so we actually don't really talk about impact in the way we sell Polymath itself. And we talk about really the market and the growth potential and the digitization of the region. And then we like add some nice human stories, but that's not really the main sell. So even if that is an important driver of you as a founder, you need to understand that that's not what people want to buy, or that's not what the big chunk of investors want to buy. And then it doesn't make sense to focus on that as your storytelling. So this is really a market segmentation, and you would deal with it as any market segmentation, right? And then I think the other part that's important to understand is the personal connection. So at the end, especially in the early days, but even I would say later, investors invest because they trust you, right? And so you need to understand each person, each institution, and as a good salesperson, build a relationship, make people feel important, make them feel heard. Nobody wants a transactional relationship, right? And so building the relationship with the investor, as you would any kind of customer-centric founder to your customer, is the right way to think about your investor, rather than, oh, these are just people that I'm going to try to convince to give me some money, right? There are different set of customers that you need to segment and understand well and build kind of non-transactional relationships with. So the fourth lesson is tell a story, a very big story, right? So early stage investing is never purely a financial exercise. Actually, I would argue that very little investing is a pure financial exercise. So there's a lot of unknowns, there's a lot of leaps of faith, things to be proven. And it's not just about like your total addressable market or just explaining how your current product works. I mean, you need to do that. You need to talk about the total addressable market. You need to talk about how your product works. But what's really important is the storytelling. So what is the problem you want to solve? Because the solution, and even sometimes the market changes, but as the true entrepreneur, and not just somebody that like wants to build his or her own company, like as an entrepreneur that is driven almost beyond reason, right, to solve an important problem or a problem that's important to you, that needs to be communicated well. And so I think this piece is, I would say, often overlooked in the early stage in terms of how you actually build that relationship with the investor. They really want to understand who you are, what drives you, because the road is going to be really choppy. And so if they don't feel going to be in this for the long haul because there's some identity that is linking you to this particular company, like I would say a lot of investors, savvy investors, would not invest, right? Because if you give up on it, then like it goes nowhere. Like there's no assets to sell. Go ahead. I think somebody wanted to ask a question.
Hey, Wenyi, how are you? This is Andres from Pardux. In regards to this point, I'd like to get your feedback. Well, first of all, congratulations. I mean, 1,000 pitches, that's ridiculous. So that's amazing.
I don't know if that's a congratulations, but yes,
I almost fell off my chair with those metrics you had. But anyway, when you're telling a big story, and as you said, at the early stages of the company, there's this thin line between underselling your story when you kind of just talk who you are as a small company or as a big idea with the small operation, or perhaps not even an operation, just an idea, and then underselling that big metric that you want to get to. And then the other, how quickly you can go to the other side where you just, you're building castles in the sky and you think that this is the next Amazon and this is the next, like, this huge hype around it where seasoned investors look at it as, full of, what. How do you, with your experience, have distinguished the sweet spot of telling a big story without selling castles or white elephants that can come off as unrealistic, I guess?
Yeah, I think that's a very good question, and I think there's different parts of the storytelling, right? So I think the first one is, I think there is what is the market potential, right, part, which I think that's where the big part comes in. So that's where you paint a total addressable market that is realistic. Like, as in, you're not just saying like, oh, I'm just looking at the e-commerce market in Latin America. I don't think that's a very thoughtful total addressable market, right? So the actual total addressable market for the product and business that you're in some like very clear adjacencies, I think that's where the big comes from. But I think the story is not the TAM, right? The story, I would say, is about your personal connection to the problem.
Okay.
Right? So, because the TAM is a number and everybody can put the same freaking number on their presentation, the story is what's interesting. And the story, I think, let me give you an example from Polymath. So I've been building in Latin America over the last 9 years. I'm not from Latin America and my family's not from here, but I feel that solving the challenge of the middle class, kind of this middle income trap in Latin America is my problem because of how big it is, how kind of like unsolved it is, based on my background of like growing up in China and then the US and being very interested in what creates inequality around the world and so forth. That appeals to me. And I actually understand technology, right? I've learned, so I have both, I really care about the problem in a fundamental, this is like my identity type of way. And the second one is I have a lot of like not unique skill sets, but kind of perspectives and skill sets that are unique in the way that they come together, let's say, to help address that problem, right? And so that's my story, and that story is important to attach to the big.
Got it.
Right? And then there's the how, which is kind of lesson number 5. So I'll get to that when I get there. But does that answer your question?
100%. In fact, you're giving me a really good idea of how to like kind of turn around my pitch a little bit around that big problem to be solved, not on just the characteristics of what makes it a problem, but why is it such a big problem? So I really appreciate it. Thank you.
Let me give you you another example, right? So if you look at, I was listening to this podcast by the founder and CEO of ThreadUp that just went public a few months ago, right? This is the secondhand fashion marketplace. And I think he started working on it in 2008. And at least the way he tells the story is he says like, look, secondhand is like a very challenging issue for e-commerce. It's one in which you have unique SKUs. Usually the ticket sizes are pretty low, right? And all of this. So it's kind of an extreme state of e-commerce. And the way he thought about it, and I don't know if this is like retroactive, but the way he tells the story is the way he thought about it is if we can solve this problem, then we can solve many other problems related to e-commerce. So that's a different way to talk about the bigness of the problem, of saying this problem is not only big in terms of TAM, but the way he tells the story is this problem is like, if we solve this very key or very extreme case, then the pie is open for us to take. So sometimes it's also not just about TAM, it's about like the depth of the problem that you're solving or the importance of the problem that you're solving that then unlocks a lot of other potential, right?
Absolutely. Thank you. Thank you. Very enlightening way of looking at this whole thing with a big story. Appreciate it.
Cool. Good.
Thank you so much.
So, and by the way, please interrupt me as I go through this because I prefer kind of answering questions along the way. So this is the lesson number 5 I was referring to. So you need to talk about why you should win, right? So it's not just like, here's the potential, I've identified the way into the problem and why I'm uniquely passionate about it, but how, like, why should you win? So after you've distilled your story to its essence, then you need to talk about the how, right? So it's not just about the problem and opportunity that you found. You need to understand and be able to explain why this product, why this team, why this company has a real chance of winning. And I think I would say that like 95% of early stage pitch decks I see don't actually explain this. Right? And I think this is very interesting because later, yeah, go ahead.
I have a little question here. What is your definition of win? Because it could be different, it depends on the person, but for you, what's the definition of win for a startup?
I think for me, at least for the early stage, I think winning means you truly find product market fit for the segment that you've identified, right? So I think most of the pitches all the way up to Series A is like a combination of I've identified a really attractive space.
Mm-hmm.
I actually am somewhere on the right path to product market fit. And I have the right, like I have at least founders or leadership team that can take it to the next level. Okay. I mean, that's really the pitch, or that's really what you need to convince the investors to believe in. So that's what I mean by win in early stage pitching.
Okay, thanks.
So I think in talking about this, like, how, I think it's very important to highlight what's the distinctive insight you have on the problem or the solution, right? And of course, I'm assuming that you're pitching like sophisticated investors, but I saw some of the startups in the batch, and like I think a lot of the problems are interesting. They're relevant problems, but there's also other people building solutions in that space, or even like international competitors in that space. So what would it take for the local startup or your particular solution to win that? And there's usually a good answer, right? Because these spaces are very big and product market fit is usually pretty granular. So But I think you have to figure out a way to explain that well to the investor, right? So what's the distinctive competitive advantage that you are building with your team? Like, it doesn't mean you've built everything, that's a process, but do you know what is that competitive advantage that you need to build, and how far are you on your way of building that? You know, what is the loyal base of customers that you're building? What is your focus? Like the specific sub-problem and the segment that you're serving well, and the right way to tackle that problem, right? So you need to figure out a way to explain thoughtfully that you have a strategy to product market fit. And then also, like, what are the current challenges, and how are you dealing with those challenges? Because really understanding what you've accomplished and what you're still needing to accomplish on this journey to product market fit tells the investor a lot of, because I think a sophisticated investor knows that not everything is figured out. And if they're really going to take early stage risk, they know that they need to take certain types of risk, but they need to be talking to a founder that is like lucid in understanding where they are in that journey. So there's a lot here. I just want to make sure that like this is clear, whether you guys have any questions about this. Okay. All right. So number 6, manage a disciplined process, right? So we've been talking about like the nature of fundraising as almost a job, and your customers as your investors as your customers, and how to tell this authentic, audacious, and compelling story. So let's now talk about the process, because the process is very important. So don't leave something as important as fundraising to chance. You saw in the numbers in the beginning, like at Polymath, we've done our homework in order to consistently raise money, right? There's very few instances in which we've gone out and tried to raise money and not been able to. It's always a freaking it's always harder than you think it's going to be, but we've almost always gotten it done, right? And so what does it mean to manage a disciplined process? First one is you need to do research to form a hypothesis of why an investor should invest in your company, right? And that's also stage-based, right? So what's the investment thesis? So for example, e-commerce will take off in Colombia in the next couple of years, and I want to bet on the best team in the market. Like, that's an investment thesis. So you need to think about it not from your perspective, but from the investor's perspective. Because if investors have not figured out what are their investment theses, the likelihood that you will convince them in time to invest in your company is very low, unless they're like friends and family, right? So you need to understand what actually is the investment thesis that would match what you're doing as a company, and then do the research of investors based on one or multiple investment theses. The second one is you need to hustle and get a lot of leads. So you need to work your networks, you need to work your networks, right? So you need to get to that second order contact, third order contact, and that just takes a lot of work. There's like no magic to it at the end of the day. And you have to qualify your leads. So because you don't have infinite time to spend time talking to people who have more time than you to talk, right? So this is especially important with Latin American investors because people are not very good at saying no. So figure out very quickly the segmentation of investor that will actually invest in you, and the key questions that help you understand if that investor fits into that segment, or key questions to help you figure out if an investor fits into that segment. So what are some questions? What is your top criteria to evaluate a startup? Have you invested in startups before? How many investments are you planning to do this year? Right? For basic qualifying questions, this is like, think of it, it's not a call center, but think about like a lead qualifier in your company. You have to do that with investors, right? So if an investor is not able to clearly and convincingly give you an answer on basic questions, the likelihood that he's going to be able to cut a check is really low. And generally, I would say the timeline between meeting someone and getting them to write a check, it's probably on the order of between 6 months to 12 months. Right? So there's a lot of lead time. That means even in this round, to some extent, you need to be thinking about developing relationships for your next round. Because by the time you wait around to the next round, it's very unlikely that you will raise from someone you just met. So that adds a whole other layer of complexity, right, related to this, like generating and qualifying your leads. Create timelines for yourself and for your investors. So set a closing date, push 1, 2 people over the line. My rule is if I close 50% of the round, that round's gonna get closed. Like it's happened every single time, right? So if people make decisions much faster if they feel that they might miss out on something. So you kind of have to, like, I do not lie when I fundraise. A lot of people do. I do not encourage you to lie, but you have to kind of generate, you have to sometimes push the edges of saying like, yeah, this person's committing, even though they're like maybe one step away from committing, just to generate that momentum that people jump, right? I haven't found another way to herd cats besides kind of creating a little bit of that feeling, fear of missing out. So that like investors are very much driven by fear of missing out. There are very few investors that are not driven by that, and they're probably, you know, going to be the next Warren Buffetts of the world, right? So you kind of need to understand the psychology of an investor. And you have to keep discipline until the end. Even if after people have told you yes, even if they have signed the paperwork, things happen. So a deal is not closed until money is in your bank. Keep your plan Bs and plan Cs active. This is a, you know, everything has happened to us, right? So you just kind of have to be a bit paranoid until money is actually in your bank account. The next lesson is very important. So each round is different. So just like what it takes to be a good student in first grade is different than fifth grade is different, being a star in high school, every single successive round of financing is different. So just because you were successful last time does not mean that you will be successful the next time around, right? So the company is different, the market has probably evolved, there's a lot of external factors that have changed, and the type of investor that will invest will be different as well. So really think about each fundraising as a totally different exercise. I mean, there will be some things like, okay, managing a disciplined process that will transfer over, but a lot of how do you pitch, what do you pitch, what type of investors, what metrics do they look at, even some of the key terms, those will be different. So as part of each round is different, right? So Series Seed, you need to articulate a problem and a good team. Maybe the names of the rounds keep changing. I feel like what used to be a Series Seed is now a pre-seed and so forth, but you get the point. Series A, I think today for a Series Seed, you probably need to have some level of product market fit, maybe the initial product market fit and not the full product market fit, because seed rounds are getting bigger in Latin America than they used to. Series A, you have to have product market fit. There needs to be no question that you have product market fit. And this has to do with repeat usage, how important your product is for the initial customer base, like how much would their lives or work be affected if it were taken away, right? Series B, you need to prove at least 1 to 2 ways that you can grow your business reliably and with strong unit economics. Okay, like there are companies that raise Series Bs pretty phenomenal Series Bs with like pretty crappy unit economics, but like that's a bet, right? Like if you haven't had those VC relationships for years now, probably that's not going to happen, right? So I would say your unit economics needs to look pretty healthy by the time you go to a Series B. Number 8 is kind of a hard advice to give, but I think it's important to mention. So sift through the noise to understand the market feedback. I think one of the hardest things about fundraising, since you're receiving no's all the time, so you need to have like really thick skin to deal with it. Because if you come down emotionally every single time you get a no, like you're gonna like want to kill yourself by the end, right? So you have to like, and there's also like a lot of bad investors out there that like they're just never going to invest, or they have some bias and prejudice against you or like the market you're in. So what they tell you and about why they don't invest sometimes is not very valuable feedback, to be honest. Like it's not like investors are necessarily smarter or understand your business or your market better than you. But it's also not a good idea to completely shut off all the feedback, right? So some of it really does tell you about how the market views your business or the capability of the team. And so I think my advice here is really identify who is a smart investor and who wants to help you. Like even if they're not going to invest, you know, I've met people before who genuinely like thought, trusted me, believed in me, but just like were not willing to invest. But they're willing to help you and they're willing to give you like pretty good feedback, right? So write it down, think about it over time. So no one is going to understand your business and your company as well as you, and not all the advice is going to be correct, but like allowing these provocations from these smart and experienced investors to help you step back from the day-to-day of running your company and selling your company to give you a different perspective on your business and help you make some important strategic decisions about your business and about your team. So this skill, right, of being able to filter the noise to actually understand some core market feedback, I think is actually very important skill to develop over time. It's not easy. I mean, it's not easy to straddle kind of the tension here, but I think it's something to consciously try to develop, right? And then lesson number 9, nothing beats building a good business, right? So we've talked extensively about fundraising in the last like half an hour. Even though fundraising is a skill, it's a disciplined activity that a CEO needs to have and do. It will not cover completely for bad business performance, right? So think about, you know, practically it means think about when you go out and raise money. So if you go and raise when you haven't demonstrated enough traction, you will end up spending and maybe wasting a lot of time because you're not able to raise, right? And this is a mistake that we have made before at Polymath. And, you know, sometimes it's nearly fatal, right? So now that there's more investors in like looking at Latin America, and some of them are sophisticated, there should be a pretty clear, or at least clearer milestones for when should you go out for a pre-seed, when you should go out for a seed, when you should be going for a seed plus, when you should go for an A, when you should go for a B. Like, I think experienced investors or advisors should be able to tell you this. And you shouldn't go out and fundraise because you need money. I mean, obviously that's very obvious that you should do it, but you really should raise enough money so you can get to that next milestone with some cushion, right? Because if you don't get to those milestones and you're just out there raising money and raising a bridge, the likelihood that you don't get there is very high, and you've actually spent all of your focus as the CEO or the founders trying to do that instead of maybe cutting costs so you can actually lower your burn. So especially I would say for once you get to Series A and Series B, you have, it's pretty clear what types of metrics you need to demonstrate before embarking on a full fundraising pathway, right? And otherwise, if you're not there, I think it's better to figure out a way to raise some bridge funding from committed investors that are already with you or to reduce the burn of the company to extend runway and prove a couple of things clearer before going out to raise. So really nothing beats building a good business. Okay, so that's it in terms of my presentation. I'll stop the share and open for questions. And also, like, I think we have a bit of time, so if you want to give some background before your question, you want to ask a more specific question related to the situation that you're facing with your company on fundraising already, I'm happy to kind of delve into more specific situations as well.
Great. Juan Daniel, I think you had your hand raised.
Yeah. Hi, Wenyi. First of all, thanks for the talk. It was amazing. I really like the part where you like specified like on pre-seed, you should always address like the problem and the team, and then as you say, and I think that's really helpful. But I want like does that really happen and works in South America? For example, I usually, one of the things I have always done is like trying to address everything on my pitch, even if I am on early stage, like, hey, I have product market. Like you always try to show that you have everything set up already. And I think that's a mistake. So I like the part where you specify, hey, let's just concentrate on giving feedback on the problem and why my team is ideal for that. And I think I'm in that position. So that's why I want to understand it really doesn't matter the rest or it matters, but I should only focus on that part. That's my question.
So I think that, it's not that you have 2 slides for your pitch, right? That only focuses on the problem. So yeah, I think you need to talk about your product. You need to talk about whatever traction you have, but I do not think you will be like, I think what I put there is how you're going to be judged, right? So for example, how do I judge the quality of a team? I can only judge the quality of team by, a little bit by the traction that you have. Like, what have you been able to build with the resources that you have? So that's one way I'm going to judge the team. The second one is I'm going to ask you a lot of questions and like try to understand how deeply you've thought about the problem. And so, and the other one is how like self-aware you are as a person. And so for me as an investor, I pay a lot of attention. And by the way, since we bring like entrepreneurs and residents in, so we're bringing them in from the beginning, for us, it's a lot about growth mindset, right? So for as an investor, I look a lot at coachability.
Okay, like let me put it in context, so maybe like we can like customize a little bit the answer. My company, what it started doing, because I'm actually right now on a pivot. What we started doing is we were a delivery app like Uber Eats or DoorDash, etc. But through the pandemic, we saw that we were actually causing problems to the restaurants because of the high fees, the commissions, and we saw an opportunity there to transform our business to a SaaS who connects directly to the direct-to-consumer channels that the restaurants have, because they want to try to work more on that channel. Mm-hmm. So on my pitch, what I'm trying to say is, first of all, I understand the problem because I actually was part of the problem at the beginning, But second, I try to like give strength to my team because my team was the one who built the first product. Like we made an app that competed with Uber Eats, Rappi, etc. But then we are working on the second product. So that's like how I try to give strength to my team, because it's like a experienced team. Do you think that's okay? What would you add there?
That's right. I think the logic of that is interesting because I think pivots, the way I look at pivot as an investor is, I see pivots positively. So if you look at actually startup data, companies that are successful have usually pivoted once or twice, not less, not more.
Okay.
Right? And I think that what you want to be able to articulate to an investor is, I think in the early stage, a good early stage investor wants to see a founder that is able to quickly navigate through all the possibilities. Like they identify a problem, but the solution can be very, like there's, you know, endless solution pathways within that problem. And I think an investor, a sophisticated early stage investor wants to understand your logic in why you pick the solutions that you pick within that space, right?
Got it. And usually, yeah, go ahead.
Go ahead.
Yeah, and usually those are, but that's one of my, I've always thought about that, like somehow, because, but I don't have to actually present that on the pitch, right? It's like that will come in questions after it.
That's
right?
a conversation, right?
Okay, all right. That's it.
I think that's a conversation. I think you can tease it a little bit by saying like, this is the problem, this was the initial solution, this is why this solution didn't work, and now this is the solution. That can be in the pitch, right?
Okay.
But it's too complex for you to say like, okay, this is how I really see the system, and this is why this road doesn't work. And so I think that's the conversation, that if an investor starts asking you those types of questions, I would like kind of go full on.
Okay, got it.
Into that, right?
Got it.
Because that's probably a good sign that it's a good investor, and they're looking for you to be opinionated and thoughtful.
Got it.
In that
All right,
discussion.
got it.
Now,
Got
in
it.
terms of the team, I think usually one is like, how did the team react to pivots, right? I think that's pretty important to be able to convey. I think the other part is, are teams complementary?
Yeah.
Right?
Like the active members, yeah.
Mm-hmm. Yeah.
Right.
So that's something to look for.
Amazing.
The other one, which is kind of shallow but could be deep, is how do the backgrounds of the teams help give you like a shortcut? Because learning in a startup is really expensive, basically. So if the investor has to fund all of the learnings, that's inherently more risky. So if you can convey how certain backgrounds of team members essentially shortcut some of the learning cycles in a relevant way, I think that's also good.
All right, amazing. Thank you.
Mm-hmm. The other thing I would add is I think there's like a interesting tension between like this is what I meant before by coachability. I think there's an interesting tension to navigate where you need to like have an opinion, or you need to have lots of opinions, because if you go to a meeting and the investor asks you a question and it looks like you haven't thought about the answer to that question, like that's not good, right? Like most questions that an early stage investor throws you have been like obsessing about the problem for like years. So like you shouldn't really not have an answer to almost anything that they say. But that doesn't, so I think you need to come across as knowledgeable. You've thought about many things. You've been, the questions have been going around, or the answers and the different choices have been going around in your head. You've discussed with your team. You've tried different things. Like you want to give that impression, and hopefully it's true. But the other thing is you need to also display openness, right? Because investors look for coachability. And it's because the likelihood, unless you're an experienced entrepreneur, the likelihood that you can anticipate the next step, well, even though you've been obsessing for many years, you're gonna like not be able to anticipate everything. So that's why you also need the openness part, and you need that combination. So as you're like going back and forth with the investor, you need to kind of balance displaying those two sides.
And to add on that, maybe it's not a question per se, or if you have a comment on that. I don't know if you found founders that get asked questions, but they answer the question, but then go on to some sort of tangent, and use up valuable time just to ramble about what they want to convey rather than to listen to the questions and keep on extracting information from the possible investor?
I mean, I think that, yes, obviously, I think listening is very important, right? And this is also around, like, how do you view the investor, right? If you think it's a transactional relationship or not, right? So this goes to, at the end, it's about relationship building. And if you think it's about relationship building, the likelihood that you're going to listen is much higher, and thus you're more likely to answer the real question that they have. But I think it's also like there's certain techniques, right? I think it's important to say, have I answered your question? And not assume that you have. I mean, those are like very simple things, right?
I have a question about your company, about Polymath. You mentioned that you develop your own ventures within your organization, or you are also an investment company that invests in other types of startups and companies, or all you do is within, like,
everything
in-house?
we do is within. I don't think we're like philosophically against investing, but you just can't do two things well, let's say. We do invest in our startups as they go for follow-on rounds, which are not led by us. So they're led by outside investors, and we have to make a decision whether we're going to put capital.
Right, but they're homegrown
They're
startups.
yeah.
Got it. Thank you.
Hi, Wenyi. Thank you. It was amazing. I have a question. What's your definition of product market fit? I have different definitions. I heard a lot of different definitions, and so
Right.
what's yours?
Okay. So I would say that product market fit is when you have developed a product that is 10x better than what's available, right? And then, you know, most people say like 10x is actually impossible, like actually like it's probably closer to 3x, whatever. It's somewhere in the 3x to 10x range. And then you answer, okay, how do I know if I've gotten to that, right? And for us, we, I think there's a few different ways that we measure it, and we end up kind of developing our own set of product market fit metrics per company, but it's usually somewhere related to either direct satisfaction, which I think is more hard to measure, like it gives you direction. Satisfaction gives you directionality, but returns really give you the answer, right? So now the question is, if you have a business that is low frequency purchase, which some of our businesses are, how do you then measure product market fit in those, right? And so I think we've also developed ways in which we understand what are the key components to satisfaction, and then we break those down. And we say like, okay, we know that ticket sizes need to be below this amount for people not to feel ripped off. So what are the what is the percent of ticket sizes that are below this? So I think sometimes it's very, very specific for the business that you're doing. But I think the overall concept is you have a superior product. I think in digital, at least, you have a superior product to the next available in order to really get that acceleration curve of adoption. Because if you're just a little bit better, I think it's very hard.
I know, yeah. Yeah, perfect, thank you.
Mm-hmm. Okay.
Great. I don't know if anyone else has specific questions now that you guys are crafting your pitches. You've had a couple of feedback sessions on your pitches. Most of you guys, two of them have their first one today, but I don't know if you guys have any doubts. Just like Juan Daniel said, as for fine-tuning, building these layers in your between your elevator pitch, your 3-minute pitch, and then moving on to a conversation. So if you guys have any other questions, I'll let you go on, and if not, then if when you have any closing remarks.
I wanted to add something into onto Francisco's questions about product market fit. So I think for me, especially in the early stage, it's very important to identify who is your beachhead market. So generally, it's impossible to achieve product market fit for the larger market immediately. So usually what's happening is you identify a very specific segmentation, and then you achieve product market fit for that segmentation, and then you move on to adjacencies, right? And so what I look for in the early stage is to, yes, you paint this big picture of, okay, I can eventually serve all these people, but I think usually the companies that are successful actually know who is in their beachhead market. So let me give you an example. We are just transitioning from the MVP phase into what we call the product market fit phase of one of our new builds, which is in health tech. And we are doing medical procedures, right? Where it's a medical procedures marketplace. And we've identified, for example, that men are the beachhead market rather than women, because they are much faster decision makers for these types of purchases from what we learned during the MVP, right? And so for us, we're gonna spend all of our ad dollars and all of that on this subsegment. And I think there's also, like, within that, there's certain procedure categories that we're gonna focus on as well. And so I think when we are showing product market fit metrics, we're gonna show them specifically for the beachhead market that we've identified. And we're gonna build all of the features, or we're gonna prioritize the features we built for that beachhead market. I think if you are able to articulate your thoughtfulness about customer segmentation and product features associated with that segment, I think that's very compelling for an early stage investor, because that's how this is the how that I was talking about before in my presentation. That this level of precision on the how, I think to a sophisticated investor tells, like, otherwise, how are they just, everybody's pitching them the same thing. It's like, oh, there's this big problem and I'm an early stage startup has like very little traction getting to that, right? So I think one of the big ways of differentiation is to understand within this really big problem, what is the segmentation and the kind of feature set, the core feature set that will get you to product market fit for that segmentation. And I think that level of thoughtfulness ends up being one of the best ways to convince someone that you really understand the problem, and actually the likelihood of you getting to early traction is much higher than somebody else.
And you bring that information to the pitch or in a conversation with the investor?
I would say, I mean, it depends on how long you have for the pitch, basically. But if it's a real, like a properly scheduled pitch, even if it's only 30 minutes and you are at an early stage, I would encourage you to say, this is the initial segment that we're going to focus on, and this is the initial traction we've gotten for that segment, right? Like, I think that's worth I think that's worth mentioning. I don't know if you're going to have enough time to dig deeply into that. I mean, maybe I'm giving advice that's counter to what Blend Trip is telling you guys, so I don't want to do that. But I think it's a little bit about the how, right?
No, and I agree with you. It's, you guys, my advice at least is choose a level of depth that you're gonna use for every single topic. It doesn't mean you have to go way in depth in when you just mentioned, but you have to just tease that you know it and that you're willing to have a deep conversation around that. So it's all about having an homogeneous level of depth along your pitch. Once you go very briefly around problem solution, but then you go way in depth about the features, and you just ate a third of your pitch, giving too much information around that. So it's about what topics you're gonna touch upon and touch them in the same way, treat them in the same way along that pitch. But it's just about choosing the right words and keeping them short and simple. I think you can put in much more than you think if you craft properly your message. I don't know if you agree, Wenyi.
Yeah, no, I think consistency on that is important. Great.
Do you have any tips? Maybe it may seem shallow, but around the design of the actual pitch deck, any recommendations about that impression of how you show your slides?
I mean, I always say like one key message per slide. I think one of the mistakes I see very often is trying to fit multiple key messages into a slide, because there's usually like a page limit that people give you of like, oh, you shouldn't be above 20 pages or 12 pages or whatever it is. And people end up just squeezing the same amount of content in half the amount of pages. And I think that's really confusing, basically. And so one message per slide, having the visuals support that message, I think is very important. The other one, which seems very simple, but is kind of, having the headline be really clear, like problem, solution, team. Like, I mean, these things seem like kind of stupid, but I think you need to do them because investors go through decks so fast these days that they, the other one I would say is try to be as quantitative as possible, right? Show big not big, like make sure your numbers are really visible and not embedded with a lot of text. And back up what you're saying with like visuals and numbers as much as possible. Like try to reduce the amount of words on a pitch deck. I mean, it's also different, like decks that you send versus decks that you're pitching with. But I think if you're pitching with the deck, try to reduce the number of words and try to show graphs, try to show numbers, try to show screenshots, like, this, be much more visual in that, because I think that, 80% of brain processing goes through like visual, right? Rather than words. So yeah, even when you cannot cut anymore, I would encourage you to keep cutting. The other advice I would give is, you guys are doing this, but like do a lot of practice pitches. So.
Yep, and arrive to the practice pitches as if it were your last.
Yeah. Okay, all right.
Thank you so much, Wenyi.
Okay, all right, amazing. Great to meet all of you. Good luck.
Bye, Wenyi.
Yeah,
Ciao, ciao.
Thanks, Wenyi. Bye-bye.
Thank you so much.